Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Voyager Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, so when we were looking into this one, what really jumped out at me wasn't necessarily the rocket science part of it. It was the financial science.
Right.
This company is such a fascinating mix. It's this aggressive, high-growth defense and space company, but it's built on an incredibly conservative balance sheet. I think we have to start there.
That really is the core of the story. Voyager Technologies sits right at the intersection of defense and the new space race. We're talking mission-critical stuff.
National security, space exploration, the works.
Exactly. But you're right, their financial foundation is, well, it's highly unusual for this sector. These businesses usually run on a ton of capital, a ton of debt.
And the numbers here are just wild. As of Q3 2025, they were sitting on more than $413 million in cash.
$413 million. And here's the real punchline.
No debt.
Zero outstanding debt. It's not just a healthy balance sheet, it's a fortress.
It just gives them so much operational flexibility.
Oh, absolutely. In this kind of environment where capital can be expensive, they can chase growth organic or M&A without that constant pressure from lenders. If you factor in their undrawn credit facility, their total liquidity is somewhere around $613 million.
And it seems like big money is validating that strategy. They just did that big convertible senior notes offering.
Right, the upsized one, $435 million. And that wasn't because they were in trouble and needed cash.
No, this was offensive capital. It's earmarked specifically for growth and acquisitions. It's a massive vote of confidence.
It's their war chest. It lets them make these big long-term bets like Starlab, which I know we'll get to.
Okay, so if the balance sheet is so bulletproof, why has the stock struggled so much? That brings us to the top line, which it's a little tricky on the surface.
It is. If you just glance at the Q3 numbers, net sales were $39.6 million. And that looks flat year over year.
Which, for a company that's supposed to be a growth story, flat is not good.
Not good at all. But that headline number is completely misleading. It's masking what's really going on underneath.
Because they're intentionally getting rid of an old contract.
Exactly. They're rolling off a legacy NASA services contract. Once you strip that out, the actual core franchise, the high-growth part of the business, it actually grew about 15% year over year.
15%. That is a whole different story.
A completely different story. And we know exactly where that growth is coming from.
Defense and national security.
That segment is on fire. Sales were up a massive 31% year over year. It hit almost $29 million.
So that's now what, roughly 3/4 of their total business?
It is. And that shift is structurally bullish for an investor. They are moving directly into higher priority U.S. government spending. Think missile defense, advanced communications.
The stuff that gets funded no matter what.
Exactly. And what's really interesting is that the revenue they're reporting right now is actually lagging behind the demand they're seeing.
Okay, so how do we see that? We look at the forward indicator.
You look at the backlog. It grew 10% just in the quarter, sequentially, to $189 million. And even more telling is the book-to-bill ratio.
Which came in at 1.25x. Let's just quickly break that down for people.
It's simple, but it's so powerful. It just means that for every dollar of revenue they reported in Q3, they brought in $1.25 in new orders.
So they're stacking up future work faster than they can even complete their current jobs.
Yeah.
It's a clear signal of future acceleration.
And that's why management is so confident. They reaffirmed their full-year guidance of $165 to $170 million and now say they'll probably finish at the high end of that range.
Okay, so financials are strong. Growth is accelerating under the surface. Let's talk about the strategic moat. What gives them a competitive edge?
The moat is really built around their platform strategy, especially in space. And the crown jewel, the asset with the most optionality, is the Starlab program.
The commercial space station.
Right. As the International Space Station gets closer to retirement, something has to replace it. Starlab is positioned to be a core piece of that future infrastructure.
And this isn't just a concept, right? They're already hitting milestones.
They are. They've already cleared 2 major NASA milestones for Starlab and got $4 million in cash payments for those. It proves the program is real and it's on track.
At the same time, they're beefing up their tech stack through acquisitions.
Very smart ones, like electromagnetic systems, AMSI, and Exoterra Resource.
And why do those matter? What do they bring to the table?
They bring proprietary IP. EMSI expands their capabilities in things like advanced communications, stuff that's hardened against radiation for deep space. Exoterra is all about propulsion. These aren't just upgrades, they're critical systems that clients and national security demand.
Okay, we've painted a pretty positive picture so far. So let's get to the elephant in the room that has clearly worried investors. Profitability.
Or the lack of it, yeah. That's the main tension here. They are still losing money. The Q3 adjusted EBITDA loss was $17.7 million.
And for the full year, they're guiding for a loss of $60 to $63 million. That's a serious cash burn.
It is, and that's why the valuation metrics look so rich. If you look at the price-to-sales ratio, Voyager is trading at 6.9x.
Which is, what, more than double the sector average?
Way higher than the sector average of around 2.9x. If you only looked at that number, you'd probably dismiss the stock as just wildly overvalued.
So what's the counter-argument? How do you justify paying that kind of multiple for a company that's losing money?
The justification comes back to two things we've already talked about. First, that fortress balance sheet, which gives them a runway of 4, maybe 5 years to get to profitability. And second, that rapid 31% growth in the high-margin defense segment.
So you're not paying for today's earnings. You're paying for the future earnings power.
Precisely. And what's crucial here is that if you run a discounted cash flow analysis, a DCF model, it actually suggests the stock is trading at a discount to its intrinsic value.
So the market is too focused on the short-term losses, and it's missing the long-term potential from that backlog and from Starlab.
That's the argument, yes. The market is under-discounting that future growth.
That makes sense. Now let's pivot to the stock chart itself.
Ah.
Because even with good fundamentals, the chart has been brutal.
Oh, it's been incredibly painful. The stock dropped a staggering 68% year-to-date from its 52-week high of nearly $74. That is a classic capitulation event.
It washed everybody out.
Yeah.
But it seems like that tide is starting to turn.
It does. We've seen a really sharp surge in the last month alone, over 35% off those lows.
What does that tell you?
It tells me two things. One, the selling pressure is likely exhausted. And two, the market is finally starting to digest the good news we've been talking about. The 15% core growth, the backlog, it looks like a base building phase is underway.
And the analysts seem to be coming around to that view as well.
Yeah, the consensus is a moderate buy. But if you look at the price targets, they're huge. You've got KeyBank at $45, JP Morgan at $43.
I mean, those targets imply massive potential returns from where the stock is trading today.
It signals a lot of confidence that management can actually execute on that huge backlog and push the company toward being profitable.
So what are the next big things we should be watching for? The near-term catalysts.
The most immediate one is the Q4 and full year 2025 earnings report. We need to see them confirm they landed at the high end of their revenue guidance.
And updates on Starlab, I assume.
For sure, any new milestones or contracts there would be huge, and also how they're integrating those acquisitions like EMSI.
And zooming out, the whole sector just has these massive tailwinds behind it.
Absolutely. We're seeing structurally higher defense spending everywhere. Missile defense modernization is a huge priority. And then there's the whole shift to next-gen space infrastructure. Voyager is right in the middle of all three of those trends.
So if we put this whole picture together, Voyager Technologies really does present a classic high-growth, asymmetric setup. You have the safety net of that debt-free balance sheet.
Funding this multi-year growth story in defense, plus the massive optionality that comes with the Starlab program.
It just requires patience, because you have to look past the current losses and focus on that future potential. It is a bet on the long game.
That's your look at the dynamics underpinning Voyager Technologies today. If you found this discussion insightful, please subscribe to Smart Wealth with Joshua for daily market analysis and Catalyst Talks.